What is happening with the economy? There are a combination of things happening, and they are all interrelated. One of the things is that businesses that need to borrow can't find people willing to lend to them anymore. At least not at a price that they can pay. The second big thing is that because some of these businesses cannot access the credit markets, they're having to cut back. Maybe they're slowing an expansion. Maybe they're shutting down a plant, a manufacturing plant. And so then, all the other businesses that supplied that now closed plant, they start slowing down or shutting down too. Then another thing happens. Workers start worrying about their jobs. They look for ways to cut back spending, so they delay buying a new computer, or a new house, or a new vehicle. When they do that, the people who make and sell computers, or vehicles, or houses have fewer customers. The people who make vehicles don't hire any more workers. The people who sell ovens and refrigerators do less business. Think about your favorite gift shop. The owner needs to buy stock to put on the shelves in anticipation of the Christmas season. The owner will make most of their money right around Christmas, provided they have something to sell. They will borrow the money to buy the inventory, then pay the lender back with proceeds from the Christmas sales. Or that's the way it's supposed to work, or has worked. On a much bigger scale, a miller in the Midwest will buy a trainload of grain with a short-term loan, process the grain, sell it to a huge commercial bakery, then repay the short-term loan with proceeds from the sale to the bakery. The crucial concept to grasp is that the growers want to sell grain and the miller wants to buy it. Without a third party or bank to put up the borrowed money, the grain doesn't get bought, the bread doesn't get made. When that happens, the miller has to lay off mill workers and the bakery has to lay off bakers. Credit comes in countless forms from all kinds of sources. Some loans are very basic, straightforward, and familiar. A commercial bank lends the gift shop owner enough money to buy stock for the Christmas season. The loan has a set term and a set interest rate. A bank will lend money so you can buy a house. A big bank might lend millions and millions of dollars to a company or investment group that wants to buy out another company. There are all kinds of other lenders. Big companies with extra cash will float short-term loans to other companies. Banks lend to each other. Banks borrow from the Federal Reserve System. Companies sell debt in the form of bonds to mutual funds and private investors. Endowment funds, hedge funds, and pension funds lend money. Insurance companies lend money. Theoretically, two things make credit markets work. One is a system of institutions and intermediaries that link borrowers and lenders. Bear Stearns served that function. Goldman Sachs still does. And more importantly, credit markets work on faith. Lenders have to believe that borrowers will pay them back. So what's driving this now? Fear. Yes, fear. The fear of not being paid back in a worsening or softening economy. Pretty much all the traditional lenders are simply afraid, yes, scared to lend. They don't have that essential faith that they will be paid back. So, to reduce their risk, they either don't make loans, even to very credit-worthy customers, or they insist on very favorable terms. Starting last year, several hedge funds and other financial institutions that were big players in the credit world started failing. Big names like Bear Stearns and AIG and Fannie Mae collapsed, sometimes literally overnight. On top of that came some fairly spectacular bank failures, not only in the United States, but in places as diverse as Iceland, Britain, and Belgium. In England, lenders began to wonder if even some of the most important names in finance, like Lehman Brothers, could be trusted to repay the money that they had borrowed. So, how did these failing companies get into so much trouble? Each case is unique, and all kinds of financial instruments are involved. But at the bottom of the whole mess is an almost unbelievable, incomprehensible disregard for a very basic concept: risk. Risk-taking. Financial companies work hard to get the biggest return possible at the lowest risk possible. Lots of companies became, simply put, stupid about risk because there was money to be made by making loans. Greed. Yes, pure greed. Mortgage lenders, for example, got fees for making loans, even to home buyers who had such terrible credit that they couldn't possibly pay them back. That was stupid. Companies like Lehman Brothers and Morgan Stanley got fees for creating and selling securities that were composed of these mortgages. Those companies, and the companies like AIG that bought them, convinced themselves that these securities, which the government now calls toxic assets, were somehow long-risk investments. Or maybe, once again, simply put, it was pure greed. Yes, greed. Covetousness. When these and other debt instruments began blowing up because people couldn't make their mortgage payments, and the values of the homes started to decline, that's a bad thing too, of course. Overpriced housing is part of the problem. So did the companies that held them start to decline. So then, where were all the regulators when all this was going on? A lot of the securities and institutions involved in these deals have very little regulation. Much of the regulation that is in place originated in the 1930s, before there were hedge funds and global capital flows, subprime mortgages, and credit default swaps, and collateralized debt obligations, and all the other very complicated entities and instruments that constitute 21st century finance. So then, a big part of the regulatory problem is that the institutions involved are huge and complicated and international. Too much complication. Regulators don't have the horsepower, in some cases, or the manpower to understand what is going on. A lot of the regulation needs to be coordinated among governments around the world. That kind of global regulation is being discussed, but it's not there yet. It's not really being done. Although that is a must. So then, how is the government trying to fix this mess? Well, there are three major efforts. Congress voted to allow the Treasury Department to buy the toxic assets from banks that hold them. The idea is that removing bad assets from the bank's books, a bank's loans, or its major assets, will allow banks to issue new, better loans to worthy borrowers. That is, if anybody is able to borrow any money, because the credit is getting tighter. The Treasury is planning to invest directly in banks. Well, that probably won't work either. And the Federal Reserve Bank and other central banks are trying to find ways to get money into the banking system quickly. They are guaranteeing loans, which supposedly reduce the risk of lending. But if banks aren't willing to lend, and if the credit market is frozen, like frozen solid, well, they've tightened the credit lending standards. Mostly only people with excellent credit. Well, what about everybody else? They can't have credit? Anyway, these are more signs of the end times transition days, and there are many, many